Welcome to the next episode of Blockrevision, and as today's episode is broadcasted offline, there won't be a chat going live. But if you have any questions, just put it in the comment section below the video. So today's episode will be devoted to stock market. We'll talk about crypto, commodities, indexes, everything about where the money flows. So without any further ado, let's head into another broadcast. Alright, and we are going to economy view. So recently we've been going through data that were favoring growth only major US stock indexes. So I mean that recently Tesla that has put out its data has met better forecasts than previously supposed. An upbeat earnings guidance from this carmaker has pushed us higher. So it means that we right now might be maintaining this wave of positivity on the major indexes, and those disappointments are previously been assuaged. So this optimism is right now heading many of the market pundits, to raise expectations for other electric vehicle companies alongside tech stocks as well. So higher valuations might be achievable within this or next month. Stocks right now are off to a strong start. Therefore, if you ask me, the valuations of SPX may reach the levels been previously seen even in August. But for the further going upwards, we need another catalyst. Right now, we are in a midterm of oncoming recession. However, those post midterm election, if you ask me about it, those post midterm election years are typically good for stocks. So this year might be not as bad as it's supposed to be, when those doom and gloomy scenarios were literally everywhere. When the market analysts were expecting that the worst might be yet not priced in. But for me, even if those indicators of leading economic data may not turn on much of the positivity, we may see a at least for now relief rally. So today I would like to focus on what may happen this year. If not a recession, then what? So at first let me go through some data that may explain why this slowdown may revolve around inflation, but and interest rate hikes, but with a cool down of those two factors that are expected due this year. This slowdown may be not as bad as seemed. So at first, let's head to data out of the survey. Empire Fed falls to lowest since 2020. It's U.S. Empire State Manufacturing Survey, General Business Conditions. So whether it's in Europe or U.S. right now, we are not heading into a north, but we can find some signs of stabilization around the levels of right here. For the strongest economies of Europe, whether it's France or Germany, it already started to recover. So it means that this risk on the environment is eventually getting back. But right now, for US, we need to be a bit more patient. So there is been a raft of business surveys indicating corporate weakness or outright pessimism during recent 2 quarters. For example, the Empire Fed's this Empire Fed's survey fell in January to minus 32.9, and that's the worst reading outside of the pandemic collapse. So we can find that it may tend to lower capital expenditure that may affect this future this economy rebound, but that everything might be already priced in a stock's valuation, and that's what we may expect that when the stock market is the one and the most important leading indicator, we might be somewhere through this. So what about the labor market? For this one, we can observe the slowdown right now. All right, so there are consecutive months of a slowdown, but it's not worrisome if you just analyze what happened back in 2008 and especially 2020. And so right now the unemployment rate is near historic lows, so the absolute levels remain very strong. Nonetheless, there is exactly this weakness you can find right here under the surface. So as we just go through latest non-farm payrolls report indicated a second straight month of contraction, we might be somewhat very concerned about the future. But those non-farm payrolls is not everything. It's just one of the most lagging indicator that we shouldn't really focus really on about when it comes to forecasting what comes next, as these elements of non-farm payrolls are just pricing in the elements of the condition of the economy that have been with us throughout first or second quarter of 2022. So those non-farm payrolls are the one that move as one of the last indicators that also, in my opinion, Fed is watching in a kind of a senseless way when they should have literally get track of this leading ones instead of the lagging. So this is one that we may get bothered, but I wouldn't be really massive worry just yet. So it's also worth pointing out that this 2-month streak has happened only 3 other times since 2006, but it doesn't really reflected hasn't really reflected the recession to come. We may recover and also try to thrive at least at this year. Otherwise we may get another doomy period. But I'm not harbinging any type of that now. So what about the another indicator that job postings finds and depicts us? So month over month growth in this Indeed job postings index right now is dropping. So it means that less and less employers are looking for new employees, and it means that this openings tracker is right now in a kind of a I would say slowing down mode. But even if though that was an unambiguous slowdown that led to that kind of behavior, that's also something that it's a laggard in terms of other indicators that we need to watch for, especially housing market and other in terms of consumer sentiment and also a business activity as a manufacturer as well. So this is the thing we also may watch very carefully for the future, but in my view there are more other indicators that are worth watching. So we'll just go to another one. So what about the aforementioned retail sales? So retail sales indicates the sentiment around retails, and generally speaking the hard economic data has held up well. But even in measures of actual spending, there are some warning signs emanating from the consumer, and retail sales right now is contracting. So it's a second month in a row with the December control group. With the December control group, we have fallen by 0.7% sequentially, and we can find that those elements of high inflation and also still slowing down rises pace, we may find that this the consumer sentiment may slow down for a bit, but retail sales are still reacting to what's the leading indicators instead of being a leading indicators itself. So we are just reacting to what happened back then, what happened in the economy back in the first half of 2022, when everybody was talking about the recession. So right now we may assume to some extent that the worst is over, but as always, the cautious approach is very desirable. So what about the credit card balances sorry, I need to just switch quickly through. Alright, so credit card balances have jumped even as delinquencies remain. So what does it mean to us right now? Many of the retailers are in large debt. So after this pandemic time, when those easy money have been given away right away without specific purpose, I would say, right now the retailers has literally addicted and got addicted, and they started to spend the money here and there compulsively. And what we can find right here is that the health of the consumer is antagonist to this rise right here. And normally we would see the US credit card delinquencies to behave like here, when the most I would say healthy for the economy is when it's a plateau or falling slightly. So total debt balance from credit cards rising, surging so much. US credit card delinquencies that's the white line, is also taking off slightly. Not many concern about this right now, but also need consideration of discussion. So while delinquencies remain low, overall balances on credit cards have shot up, and right now that might suggest that consumers are having to borrow more to pay their bills or fund their purchases, in my view, and that also shouldn't end up well for this time. But it means that recession may come over, but might be postponed, at least for in my view. What about next element? That's number of mentions across S&P 500 company transcripts related to job cuts, and we can find that yes, we have recently found that this job cuts has risen. It's, I would say, over exaggerated phenomenon right now. Where look at the 2016, where we were in the somewhere in a halfway of possible recession, and that eventually didn't happen. We just had a small slowdown right back in 2018, but it hasn't led to much of a problem for the economy. So current situations where there is a lot of talk about layoffs, but few new jobless claims in the data, is not that unusual, and shouldn't be a very high indicative of recession. At least for now, we can find that we've been through recession already in 2020 in terms of debt gauge, and it's very rare. It's very rare that economy might head through similar situation in such a short span. What about leading economic indicator right now, when lay is a the, I would say, an umbrella of the most important leading indicators among economy. So right now it signals a recession, as we can find when we dropped below this neutral levels, and we are turning away slightly, but still we are still far from getting this down. So in my view, even if we cross this warning signal and recession signal, it doesn't mean we may go to recession period right away. It may take time, right? So also that happens with inverted yield curve. So the inverted yield curve may be throughout one or even 1.5 year in its duration before recession eventually knocks to your door. So in terms of this LEI indicator, we may find that yes, this is concerning, and it's also need to be one of the elements of debate, but right now it's very difficult to say that we are right before something huge. So leading indicator as a composite of indicators that have been released throughout the month right now is also problematic, but doesn't mean that we may not rise major valuations of stocks, whether it's more offensive or defensive one. Right now the narration is that recession is at least postponed, and that's what the market is buying. So what could I say about it as well? yes, we had gone through two other periods where the economy had a recession, and the year-on-year change wasn't even as negative as it's now. So right now we can find that we need to just hang on for the having these things eventually being straightened out by the economy as well, of course. And market outlook. What's in a market outlook right here? So let me find out. For this one, I will get you to a trading view. Of course, I needed to switch to my Windows and just look at the most important SPX. Yes, it's right now building a ground for another move upwards. So right now we can find that we are respecting this trend line. It's breaking out of this trend line very noticeably, and even if with this drawdown on the quite significant scale of minus 1.67, we might be still in a positive mode in terms of the future path forward. Back in was it Friday or January, the huge pack of options has expired, and usually that expiration often converge with a kind of a extended spans of directional moves on the market. So this time it looks like the options decided to bet on major indexes growth, and that's what I wouldn't like to bet against. So that's what about SPX. That's about the SPX. Right now we are heading back into our presentation, and what about the market movers section? So we are right now heading to economic calendar. For this one, I will just jump to this week, and yesterday we had Bank of Canada interest rate decision, and it hasn't surprised. So those sessions, those presumptions for Fed also get us to 0.25 if we just look at Fed probability interest rate hike. Everything adds up to that it may possibly happen. What about Thursday? Thursday is the important day in terms of GDP growth rate. That's also very informative in terms of how this nature of a recession or the so-called economic slowdown looks like. So GDP growth rate quarter over quarter is due this 8:30. So we need to hang on a while. And for tomorrow, it's personal income, very important for measuring the health among retailers as well, and their purchasing power as a whole. Also ending up the week's data with Michigan consumer sentiment final. That's also worth watching. All right, so I guess that's it. So what about the earnings calendar? So yesterday was a very important day for Tesla. Let's have a look at this. So yes, we had better than expected data out of so revenue, yes, revenue missed a bit, but it also met with a better than expected market behavior when this Tesla right now is getting through possible bit milder time in terms of those recessionary concerns than that has been previously back in a third quarter expected. So EPS has surprised to the upside, and if we just I will get you just to presentation in a second about Tesla and explain you a bit more, but for now let's as we are right here just look at today's data. It's a Visa MasterCard already through, and we can find it majority 80% if not 90% of this mid or large cap stocks is right now beating those forecasts. So it means that it has a kind of a power of injection of a fuel into the next market rise. So it's about still about some names that are due to broadcast its publish its earnings reports. We have KLA, Intel, Louis Vuitton, and Visa yet to hang on. And tomorrow we have not much of a strong names, but Chevron is the one that may tell us a bit more about the oil market indeed. So we are heading back into our presentation, and I need to say a bit more words about Tesla. So just look at this data, Tesla quarterly revenues by segment after this slump in a quarter two, was it? Quarter two of 2022 right now has indicated much of a power, even with this market I would say demand slump. Tesla is right now performing in a, I would say, with a strong expectations to the future. This Tesla, Cybertruck, those elements of possibility of market expansion still are with investors. And right now, after this major sell-off that happened recent weeks on December, we might be somewhere in the halfway of a major rebound, at least in a short to mid-term period. So that's about earnings season. What about right now the element of trade idea? And I have a very interesting option for you. So let me change windows. Yes, we are right now at earnings season, but I will get you to trading view. So right now just look at this. So cotton is in a very interesting spot in terms of possible breakout. We have built maybe I would just extend the view to make it a bit more accessible. So so cotton, once again, right now, look at this volume. Look at this volume that's right now is increasing. So it means we are in a accumulation mode after this distribution has been found. Right here, that's a sorry, I just need to remove that, and right here we are winding up and building up the power to next move ahead. So cotton right now has rebounded price out of this trend line, been constructed within a midterm interval of 4-hour candles, and after building up such of a price action that's right now with convergence of such volume, we can find that we are in a halfway of a breakout. For this objective to of a pattern, if you just wonder about where the price may get, we need to measure that exactly extension of a base of this triangle, and that's what exactly gets us to is 105 level, so somewhere around this resistance right here. If we just wonder about the verifiability of technical patterns on cotton, just look at this one, head and shoulders, inverted head and shoulders right back in July of 2022 has got us right with an extension from head to the neckline, right even over to 129, so it was right back then over 15%, yes, it was 16 to 17% of growth. If we just look at the seasonality, that's very important in terms of commodities, especially cotton. We can find that we are approaching a February time when normally after consolidation in January we are noting a very nice returns. So cotton is right now in a very nice spot, but for this to catch the trend, you may better wait for a possible pullback. So right now, as on a 4-hour chart, we are heading to 70 points. Hang on for some pullback around this area, and I would try to catch that trade right somewhere inside of this blue box, being limited by 87.9 and 88.9. So if the price will get right here to this blue box right after entering a position, I would set my take profits somewhere around $100, as it's, I would say, it's psychological barrier, but as well there's where the major resistance is found. This 93 level shouldn't be an obstacle, as it already been tested twice, so we may go through it as a plain or smooth sailing, if you ask me this time. So another very important resistance is the area between 97, 98 and 100 especially. So but if you are able to take some more risk and also control the possible pullbacks that may happen right on the way, you may maintain your position right to 105 with a possible break of this trend line that I've downtrend line I've appointed. So we may something that comes out of this objective of this pennant pattern might get us right there. So it's about still risk reward profile, and this one is very decent at 9.07 indeed. So also the rise on US oil market is also the one that may favor that pair in terms of future growth. So in this episode, thank you very much for tuning in. We are done for today. Let's call it a day.